Hello and welcome to the lecture for the first part of Chapter 7. So Chapter 7 covers a whole range of different kinds of liabilities or debts that we owe to other people. So we'll talk about each of them in turn. In this part of the lecture, I'll talk about notes payable, and we'll talk about them first in a very simple form. Talk about the liabilities that arise for sales tax collection, so money that we owe to the government for the products we sell. Talk a little bit about contingent liabilities, and then one very common form of contingent liabilities, which is warranty obligations. And then I'll cover installment notes, which are the kind of notes that if you purchased a car on credit, you likely used an installment note. In the next part of the lecture, in part 2, I'll talk about lines of credit, which are fairly straightforward, and then I'll get into bonds, which are a little bit more complicated, but that's when companies borrow larger amounts of money. And we'll talk about bonds that are issued at face value, at a discount, and at a premium. And then I'll end by just talking about current and non-current assets and liabilities, the way we categorize those items on a balance sheet, and the additional information that we can glean from looking at things in that way. So first I want to start with some important definitions that'll help the rest of it make sense. So first of all, the creditor is the entity that is issuing or making the loan. So it would be the bank or the finance division of the car company if you're buying a car, or whoever is making the loan or extending credit. The debtor is a person incurring the debt, so the borrower. So in this case, we'll be talking about it from a company's perspective. So in that case, the company is the debtor. They're the ones going into debt. A current liability is any debt that is going to be paid from current assets, so meaning you're not going to roll it over with another debt, and it's due within 1 year, within the upcoming 12-month window. A long-term liability is any debts that are due beyond that year. And you could have a liability where a portion of it is current, like say a mortgage on a home. It might be a 30-year mortgage that you've signed. Well, the first year's worth of payments would be a current liability. The other 29 years would be a long-term liability in that case. We've talked about accounts payable before. That's the liability that arises through the normal course of business, purchasing merchandise, supplies, things like that. And then a note payable is a more formal kind of liability where you sign a promissory note. There's usually collateral and interest involved, those sorts of things, as opposed to an accounts payable. And again, the reason that people use a note payable, the reason I used notes payable when I was in my business, is that it allows the creditor it gives them more options in terms of making collections on that note later. So the simple note payable that the book describes are loans where you borrow money, and then when that loan matures, so say it's a 1-year loan, when it matures, you pay the full amount. You pay back the principal plus the interest at that point. So we're not making payments every month. It's not that kind of a loan. It's just, I want to borrow $25,000 in this example at 6% for 1 year. A year later, you pay the full amount. So the way this works is you can see here on transaction 1, Company X borrows $25,000 from Big Bank for a year at 6%. So the transaction at that point is on Company X's books, cash goes up by $25,000 and our liability note payable goes up by $25,000. We don't recognize any interest or anything like that because that's only going to happen as time goes by. So the second transaction there, we need to accrue interest payable at year end. That's where I've drawn the red line on that transaction grid as the end of the year. So standing on December 31st, as the accountant for Company X, I need to recognize that some time has gone by that we've owed this money. We've incurred an interest expense associated with that, and we owe interest at that point. If we were to pay the loan off early, we would still have to pay some interest at that point. So I do the math, 25,000 times 0.06, in this case times 9/12 because 9 months have transpired, and I get $1,125. So I do that math and I record an entry on the books. I accrue interest payable and I recognize interest expense. So I increase interest payable and I decrease retained earnings because expenses pull retained earnings down. Excuse me. Then on the due date, so on March 31st, at the end of that year, I'll accrue the remaining interest. So that's again 25,000 times 0.06 times 3 over 12. So I accrue the additional 3 months worth of interest by increasing interest payable and recognizing the expense. And then I pay off the note. In this case, I pay $26,500, which wipes out the note payable and wipes out the interest payable. So I've satisfied that debt in its entirety. You can see here, looking above and below that red line, that if I didn't make that accrual, if I had waited until I paid the $26,500 on March 31st, I would have made year 2 look much worse and made year 1 look much better, which distorts the picture of what really happened in that business. The next topic is sales tax payable, and sales taxes are determined based on there's a statewide rate, there's a county rate, and then there's a city rate. And so businesses that operate, that sell product to end users, retailers, they have to know what the rate is wherever sales are taking place. If they have multiple stores, they need to know the rate for each of those stores. If you're an online business and the sale is taking place at the customer's doorstep, then you need to know what the sales tax is for each individual customer in each location, because it could vary. There are sometimes taxing districts within cities, so there could be 4 layers of sales tax. So understanding correctly what tax rate you should be applying and then collecting that and remitting it to the state is an important function, because if you don't collect it from the customer, then it's the business's obligation to pay it regardless. So that can be a painful lesson to learn. So in this case, I have a simple example of an 8% sales tax. So on April 1st, Company X collects $1,080 for $1,000 in services that they provide to a customer. So again, they're charging the customer $1,000, but they have to collect an extra $80. In this case, the business is a conduit. They're collecting that money from a customer, and then in turn, they're remitting it on to the state government. So April 1st, we collect $1,080 cash. We accrue a liability money we've collected from a customer that we owe to the state, sales tax payable, and we recognize the $1,000 in earnings, retained earnings. On June 1st, we make a $2,000 sale, so we collect $2,160. So again, cash goes up by that full amount. Again, some of that cash is money that really we can't keep. We owe it to the government. We recorded the sales tax payable of $160, and we recognize $2,000 of sales or revenue. So at the end of the quarter, we remit that money to the state. Now we can pay it back to the state in Washington, and then they'll remit it out to the county and the city and all those different districts. So we only have to send one payment in with information about that. So in that case, we cut a $240 check to the government, and we reduce our sales tax payable down to 0. The next topic I want to talk about are contingent liabilities. And contingent liabilities are amounts that we believe that we'll have to pay in the future based on something that has happened now. So somebody may have been injured on one of our products this year, and we believe that at some point in the future we may have to pay money to settle a lawsuit. That's a contingent liability. Something happened this year, we think we're going to have to pay money in the future. It's not cut and dried. It's not black and white like a note payable or like sales tax payable. There's some squishiness to it or estimation involved, but we do need to recognize it when we think that it is actually going to happen. So in any of those kinds of cases, we're going to recognize 2 different things about it. We're going to say, what is the likelihood that we're going to have to make a payment in the future? And it could either be probable, reasonably possible, or remote. We would look at it one of those 3 levels of likelihood, again, based on our estimation. And then we would try to measure it. So can it be estimated, or is it not possible to estimate that expense? Those would be the 2 criteria that we would look at any kind of contingent liability. So the way that flows is if the contingent liability is both probable and we can estimate it. So say we've been sued this year and we look at it and say, yeah, we're going to have to pay out a settlement because we were in the wrong in this case. And we can estimate that, yeah, I think we're going to have to pay out $10,000 at some point in the future. Our lawyers told us that's probably what it'll be. So that would fall in that far left column. It's probable and we can estimate it. In that case, I would need to recognize it in the financial statements, meaning I would have to create a liability called lawsuits payable or a contingent liability, and then I would recognize an expense at that point, even though it hasn't happened yet. If it's reasonably possible, so not probable, it's maybe in the 50% range, or probable but we can't estimate it, we would just disclose it in the notes to the financial statement. We would say, we've got an issue here. We don't have all the information. We can't say for sure this is going to happen, but just please be aware of it. And then the far right there is if it's remote that we're going to have to pay any money, then we don't need to recognize it or disclose it either. It's just a minor detail. So one example of a contingent liability is warranties. I just saw a billboard the other day where I think it's Kia now has a 20-year, 200,000-mile warranty. So when you buy a brand new Kia, you can look forward to it. I think it's probably just applies to the drivetrain, but you can have that repaired for the next 20 years or 200,000 miles for free. So when the company makes that sale, it's very likely that they're going to have expenses in that 20-year span that they're going to have to pay money for. So that's a good example of a contingent liability. We made the sale now, we sold somebody something, we need to recognize that we may have a liability in the future associated with that sale that we made this year. So here we've got a company that sells products costing $20,000 for $50,000 in cash. So again, I recognize the sale first. So cash goes up by $50,000, retained earnings goes up by $50,000 to recognize revenue. And I recognize the cost of that sale. So I reduce my inventory by $20,000 and I reduce retained earnings by $20,000 for cost of goods sold. And at the end of the year, I estimate that my future warranty expense is likely to be 1% of annual sales. So that's either based on my past experience or industry averages or something like that. So I recognize a payable and I recognize an expense associated with that warranty in the same period in which I made the sale, because that expense should be matched with the benefit of making the sale. So in the following year, we honor a warranty claim. We give the customer $100 worth of parts for free. So when that happens, we don't recognize an expense at that point. We've already created a provision for that in our warranty payable, so we reduce that payable. So in that case, we reduce inventory by $100 and we reduce our warranty payable by $100 because I'm honoring a claim that I accrued in a prior period. Again, that red line delineates 1 year from the next. The next thing I want to talk about are installment notes. So again, that's the most common kind of note that you might that a company might have if they're buying equipment or a building, or you might have if you purchase a home or a car or something like that. So the key thing about that is that there are periodic payments that are made that are a fixed amount for the term of the loan. So you're going to make an identical payment every single month in this example. Now I've uploaded an Excel spreadsheet that's got some formulas in it it's a loan amortization template, and I uploaded it to Moodle just for you to play around with. You might want to save a copy of it to your computer because it's a handy thing to have, and you can play around with putting in different loan amounts, different interest rates, and that sort of thing to see what payments show up, because the bank will use that kind of a formula to come up with what that periodic payment should be. So for each payment that you make that's an identical amount, a portion of that payment is going to be applied to reducing principal, and a portion of that payment is going to be applied to interest. And the interest is going to be calculated based on the outstanding balance of the loan during that month. And so the interest portion of the payment is going to be high at the beginning, and it's going to go down. And conversely, the portion that relates to the principal is going to be low at the beginning and increase over time. So if you're a company and you borrow money from a bank, like to finance a truck or something like that, you would ask for an amortization schedule, or you would create one yourself so that you would know how to record each of the payments that you make on that loan. So here's an example of a loan amortization schedule. It's similar to the one that you have in your book, but this one I think has a little more information. So it's a $24,000 loan. The interest rate is 6%, and they are making annual payments to just kind of keep the math easy. So the bank has determined that the note payment each year should be $5,698. So you can see they're making that at the end of each of 5 years. So for the first year, the amount outstanding that whole year was $24,000. So the interest portion is $24,000 times 6%, or $1,440. So of the $5,698, $1,440 applies to interest, and the remainder, so $5,698 minus $1,440, is going to go towards decreasing the note payable, go towards principal. So when that amount is applied to principal, now the carrying amount on the loan is going to be $19,742. So then that is the amount that's outstanding the whole second year. So that's the number that we multiply the interest expense to get the interest expense for year 2. So you can see the interest is going down because the balance is going down. As the interest goes down, a portion that goes towards reducing the note payable goes up because we're making equal payments. And you can see in the end there, based on maybe there's some rounding involved, but it's going to end up being that we zero out the principal of the loan with our final payment. So the reason I would need to do an amortization schedule like that is each year I'm going to pay out $5,698 in cash, and I need to know what the other side of the equal sign is going to be. So how much am I going to apply towards the note payable column? How much am I going to pull down retained earnings for interest expense over that period of time? So by doing that amortization table, I can go ahead and record each of those entries appropriately at the end of each of those years. So hopefully that makes sense. I will talk to you again in part 2 of the lecture for this chapter. Thank you.